Hello guys and welcome back. We are still doing basic groups. We're in the first chapter of P2. This is still P2, Corporate Reporting, ACCA, paper P2. And we are still in the first chapter, chapter 1 on basic groups. In fact, we're still doing the same question that we were just a moment ago. The question Peddle is, as I mentioned to the video in the last recording, kind of the basic question. But I want to use it as a way of teaching you one or two other things that I want to explain to you, quite frankly. There's a couple of things I want to point out to you. And they're both referred to as roll forward. In fact, there's three things I want to refer to you. They're both known. There's roll forward, and full and partial goodwill. So those are the three things I want to look at. The first of them is roll forward on NCI. Now, I'm not going to make you go back to the previous recording. I'm just going to remind you of how we calculated NCI on the balance sheet when we did the question Peddle. Okay? So here we go. We're going to calculate NCI for the question Peddle. So it's question Peddle from basic groups, and it's a return to that question. The first thing I want to do is calculate NCI. Now I'm going to calculate NCI by two methods. I'm going to calculate NCI by the method that I just did, which is known as traditional at. And it's the old familiar way of calculating non-controlling interest. What we say is that the non-controlling interest has ownership of two things on the balance sheet. It has ownership of net assets, and it also has ownership of goodwill. Now, you might remember from our calculations that we said that the net assets at the year end, if you look back at your notes, the net assets at the year end were a figure of 360, and the NCI had 20% of that. And that gave us 72, you might recall. So the NCI ownership in net assets was 72. But by splitting out the goodwill, we also found that the NCI had a goodwill ownership of 10, and therefore the NCI was 82. Now that figure of 82 was right. But there's a slightly different way of calculating the same figure, which your examiner prefers. And I think I have to be honest with you, in terms of most exam situations, I prefer as well. It has advantages, shall we say. It's called roll forward, and we'll see what you think. We're obviously going to end up with the same figure for the non-controlling interest in the question Peddle for the subsidiary Saddle. We're going to end up with the same 82, but we're going to get it in a slightly different way. We're going to roll forward. So what we do is we start at the start. Now if you take a look at the question, the non-controlling interest at acquisition was 60,000. So at acquisition, the NCI was 60,000. But we're going to roll that forward from acquisition forward to the now by accommodating the growth. Now if you remember, the subsidiary at the year end was sized 360 from the net assets working. Whereas at acquisition it was sized 250, and therefore the growth in the entity was 110. Now the ownership of the NCI of that is 20%. And you can see it gives the same figure. 20% of the growth of 110 gives us 22. 22 onto the 60 gives us 82, right? So you can calculate the NCI by using either the traditional at the year end, where you don't worry where the figures came from, you just concentrate on the year end. If we have an ownership in goodwill, we consider that. If we have an ownership in net assets, we consider that. We bring it together. We don't worry about rolling forward. We just work at the year end to get our 82. That's traditional at. The other way of doing it is, as you can see, roll forward. We find out how big the NCI was at acquisition, then we grow it to the now. Now, looking at it, as you see presented to you on the board now, it probably looks, roughly equal in terms of its difficulty. But the big advantage of roll forward is that you don't have to calculate this figure. You don't have to calculate the goodwill ownership allocated to the NCI. You don't have to split out the goodwill between the controlling interest, goodwill, and the non-controlling interest, goodwill. You don't have to do the goodwill split. Because you don't have to do the goodwill split, the roll forward method is considered preferable. And that's the one that I'm going to use by and large from now on. So I'm going to prefer the roll forward method for NCI. Now, for no particular reason, the examiner seems to have swapped his accounting not just for the NCI to roll forward, but also for the associate to roll forward. So let's now have a look at the associate both ways. So we're now going to look at, we're sticking with the question Peddle, but we're now going to look at the associate. We did, of course, traditional at. And it worked perfectly well. We concentrated, traditional, we concentrated on the year end, at the year end, on the balance sheet. We said to ourselves that the associate has some goodwill. We worked out a figure of 21. And it also has some net assets. The net assets in the associate, I can't remember, what was the net assets associate? Was it 470? I seem to remember it was 470. Yeah, it was 470, wasn't it? So the net assets were 470 at the year end, and we own 30% of that 470. That 470, that 47 times by 3, gave us 141. So we had ownership at the year end of 141 in net assets, ownership at the year end of 21 in goodwill, and a combined figure of 141 plus 21 gives 162. We had the figure right. It was cool. It was fine. So traditional at worked with the associate as well. Now, I think for no other reason than he's decided he likes roll forward with the NCI, the examiner is now starting to look at roll forward with the associate as well. And I can see advantages. What you do is you find out how big was the associate at acquisition. Well, the associate was worth what we paid for it at acquisition. At acquisition, you have a figure of 120. Can you see that on the balance sheet? 120. So the associate at acquisition was worth what we paid for it at acquisition. But since then, it has grown by the growth. Now, how big is the associate now? It's 470. How big was it at acquisition? I seem to remember it was 330. The growth is 140. Of that growth of 140, how much is ours? 30%. 30% of 140, that's 14 times by 3, so 14, 28, 42. 42 added to the 120 we have at acquisition. 42 plus 120 gives us 162. Now, again, they look roughly equal, don't they? They look just as good as each other. It doesn't seem to matter whether you do a traditional at or you do roll forward. Now, the reason that roll forward possibly has a slightly better technique is the same as the other one. You don't actually need to calculate the goodwill. If you simply do roll forward, you don't need to calculate the goodwill in the associate. Now, I really don't know exactly why it is the examiner, after years and years and years of preferring at, has suddenly gone for roll forward, but it does seem to be the case, and you can see the advantage that he is getting from swapping from doing his traditional at that he's done for at least 10 years to doing now roll forward accounting for both the associate and the NCI. And therefore that's what I'm going to do. I'm going to do, by and large, I think, to be honest with you always, I'm going to be doing roll forward for both of those. NCI particularly, but if I have an associate, I'll roll that forward as well. Well, that's the first two things I want to tell you about. The other thing I want to tell you about is a very, very separate thing. It's about goodwill. And I think I'm going to open up a blank section right here and just give you a nice heading there for goodwill. Now, goodwill, under the new IFRS, oh goodness, bit of a curly 3, IFRS 3 revised in 2008. There are two possible assumptions for goodwill. There are two policies, basically. There's the one that we did called the full goodwill, and there's the one that I'm going to show you now, which is going to be rarely examined, but you have to be able to cope with it. The two policies available are: one, full goodwill, where the NCI is valued at fair value and assumed to have some goodwill. Full goodwill, where the NCI is valued at full value. That doesn't look like a U, does it? Full value? I don't mean full value, I mean fair value. My apologies. Maybe I said that out loud, but I didn't write it down, did I? Full goodwill is where the NCI is valued at fair value and is assumed to have some ownership of goodwill. That's going to be the usual one that the examiner is going to use probably 90% of the time. So that's the usual assumption that the examiner is going to make. And the other one too, partial goodwill. Where the NCI is valued at its proportionate share of net assets. and is assumed to have no ownership of goodwill. And that's going to be an occasional assumption by the examiner. Probably a rare assumption by the examiner, but as we work our way through questions through this course, we'll talk about situations where that assumption may take precedence over the full assumption. Now, the partial goodwill goes by different names, unfortunately. The examiner usually calls it the partial assumption, but he has also called it the proportionate assumption, as you can see from that phrase there. So, rather annoyingly, it's also called proportionate goodwill. And even more annoyingly, it's actually got a third name, which is net goodwill. Which is very annoying, isn't it? Very annoying. So we have full goodwill, which is always called full goodwill, thank goodness. And then we have the other one, usually called partial goodwill, which is proportionate goodwill or net goodwill. Now at the moment, this is all just a load of words slapped onto the board here behind me. And doesn't really come to life, and therefore, even though we have actually done the calculation for full goodwill and we've completed the question Peddle, I'd like to go back through that process of calculating goodwill just for the subsidiary and do it both ways in front of you so that you can really see what it is that the examiner is referring to. So if I can just get a bit of space for myself, what I'm going to do is I'm going to do goodwill both ways. So I'm going to do it on one page, so it's going to be a little bit of a squeeze in front of you, but I'm sure we'll survive. Let's see if I can write goodwill a bit neater. My I's and L's seem to have ended up looking the same. There we go, goodwill. So we're going to have the sort of table of descriptors on the left here. So we've got the fair value of consideration and the fair value of NCI, the non-controlling interest. That combined gives you the fair value of the entire business, and we're going to compare that to the fair value of net assets. Now we're still doing the question Peddle, so this is basically a continuation of the previous recording, you see, so we're still using the same information. What I'm going to do is I'm going to line up a working with percentage here and working and full goodwill here. And then I'm going to do the same thing again on the right hand side. So I'm going to go percentage, working. It's a bit of a squeeze, isn't it? But I think it's worth it. So we've got them next to each other. And partial goodwill, as it's usually called. And I'll show you how it's done. You already know that the full goodwill is 70, because I produced the answer, the full answer, in the previous recording. So we know that the full goodwill is going to come out as 70, but I just want to show you again. So if we make the full assumption, then we're assuming that we're going to value the NCI at the fair value. The fair value of the NCI at acquisition was 60,000 as given in the question. Just change to purple so you can see that. 60,000 as given in the question. And that represented 20% ownership. In fact, we purchased the other 80%, and the value of that was what we paid for it, which, as you can see from the balance sheet, is 260. And you might remember the combination of the 260 plus the 60 gave you 320. The whole business is worth 320. So you compare that 320 to the 100% of the net assets, which is 250. And adding down, we've got 320 compared to 250, gave us full goodwill of 70. And you can see we don't really need the workings there. It seems a bit of a waste of time. But we do need the workings on the right-hand side, and that's why I like to just set up the working as a column available for our use if we need it. Because we do need it when we come to the right-hand side. The percentages are the same. But the goodwill is less. It's going to come out to be 60 actually. Now our bit of the business is worth what we paid for it. That doesn't change. We paid 260. But if those guys, under the partial assumption, are assumed only to have net assets and have no goodwill, if they have no goodwill and they only have net assets, then how big were the net assets in the subsidiary at acquisition? Well, the answer is 250. And what proportion of those net assets did they own at that point? The answer is 20%, of course. That is the NCI, 20%. So the NCI is assumed to be worth 50. It may not be entirely fair, but that assumption is available within IFRS 3. So we could say that the entire business is worth 310 because our bit's worth 260 and their bit's worth 50. The net assets don't change, they're still 250, giving us therefore a figure, as you can see, of 60. Now the examiner, like I say, I'm guessing of course as regards the proportions, but 90% of the time you're going to be doing the full goodwill calculation. Most of the time you'll be doing the full goodwill calculation. Now, how would you know that you're doing the full goodwill calculation? Because the examiner will tell you to use the full goodwill assumption. He'll tell you the fair value of the NCI, as we saw in Peddle. He will say, value the NCI at fair value. Here is the fair value, use it. Now, when you're given a fair value, as you are here, you must use it. However, if the examiner says, I want you to use the partial assumption, if he tells you to use the partial assumption, and he says he wants you to work out the NCI, he doesn't give you the NCI, he says he wants you to work it out. Well, if he wants you to work it out, then you work it out, and here it is being worked out. So if he tells you to do the partial assumption, then here it is here. It's a little bit annoying that we have two different ways of calculating goodwill available within IFRS 3. They're effectively a policy. You can do one policy or the other policy. Now, the fundamental idea of the International Accounting Standards Board is to increase consistency in financial reporting. So they're supposed to remove inconsistencies. Can you think of an existing inconsistency that was there even before this goodwill problem? Well, there was that problem of property, plant and equipment, tangible fixed assets. They can be carried according to the cost model or according to the revaluation model. And whether you do one or the other is your choice. It's your policy. That is inconsistent, and that inconsistency should be removed. But this is worse than this. This is the introduction of an inconsistency. Prior to IFRS 3 2008, there was one way of doing goodwill. It may not have been perfect, but at least there was one way. Now there are two. You can either choose the full goodwill or the partial goodwill out there in the real world. If that choice exists in the real world, it exists in the exam as well. And there you go. There is the question being done both ways. Okay. However, It is the full goodwill that is new, and therefore the examiner has said he likes to look forward, and therefore it is the full goodwill that will get examined approximately 90% of the time. Okay, enough said on that. Now actually, to be quite frank with you, I want to use this recording just to give you a little bit of a flavour of what to expect as regards the rest of the course. Now I've finished the question Peddle. I've done everything I want to do on the question Peddle, and like I said in the previous recording, please practice that question until it becomes easy, because there's lots going on. It's a very simple question, but it teaches you so many different things. It's a lovely question. Please practice it. But, you know, practicing is part of the learning process, and the learning process involves listening to me and, you know, learning from these videos. So I want to give you a little bit of a feel about how this interactive course is going to work. Now, you already have seen 2 videos, so you've got a little bit of a feel for how the interactive course works. Now, I just want to tell you a little bit about the basis of the course. Now, the course has been divided down into 10 weeks. Now, those 10 weeks are actually equivalent to the 10-week evening course that I teach, that we teach, that as lecturers teach here in London, here in Holborn in London, to the evening students who come to the evening courses. So, whilst this course is definitely not exactly the same as the evening course, it approximates to the evening course for the students who come to sit in front of me when I'm giving my face-to-face lectures here in Holborn each and every 6 months. So that's the first thing. That's how that's the sort of the culture from which this course is coming from. For me, I think it's an ideal way to learn anyway, but it's naturally related to the way that the course is being written. If I were you, I would basically treat this course pretty much as an evening or a weekend course. I would allocate yourself a good 3 hours, 4 hours every week to sit down and basically learn from me as if I was in front of you and you were copying down. So just copy down and learn the questions by the process of, you know, sort of listening to me and writing down what I write up here, you write down into your notes. I would really recommend that you kind of try and make it as live as you possibly can. Now, obviously, these recordings have been made in advance and you're not listening to me live. But nevertheless, I'd like you to try and learn in an active kind of way by actually, you know, sort of imagining me there right in front of you, have your notes in front of you, and as you're working through the question, as I'm working through the question, you're working through the question. Okay, that's the first thing I'd like to say. So that's the 10-week course. Now, if you're logged into the whole 10-week course plus revision, which I imagine most of you are, then plugged on the end of the 10-week course is the revision course. Now, the revision course, I'll talk to you, I'll talk more when I get to revision about how to do revision. But basically, you'll be getting close to the examination, and we'll start pulling up exam questions, and I'll be answering them, and you'll be answering them, and you'll be repeating them, and so forth, and you'll be doing your revision from real exam questions. So that's the revision section. Now, can I just talk for a few seconds about, more specifically about the interactive course? Now, in the introduction, that was chapter 1, right? And we're still partway through chapter 1. But in the introduction, I've put down a little bit of advice to interactive students. Page numbers might change in this pack, so I'm going to be using page numbers very rarely, but you might find it useful to try page 14. It's certainly page 14 on my pack here. Now, page 14 gives some advice to the interactive student. Now, but basically what it's saying is treat this like an evening course, you know, sit yourself down and do the questions as I do them. Now, there's a reason that this is called the interactive course. Now, the interactive part of this course is the scratch pads, the notice boards. Now, if you have if you have any queries that relate to, the questions that you're doing, the first thing to do is to, review the video, to see the video again, to do the questions again, and so forth, and practice it yourself. The more you practice it, the less problems will bother you. But if you really feel that there's something that you wish to interact over, then the way to do that is to post a posting to the notice boards. Now, there's going to be a notice board for the P2 course, and what you should do is you should post up your query, and hopefully you there in Ghana will be posting up your posting, and that guy over there in Australia will come back with his answer, his ideas, and then he will post up his particular thoughts and his problems, his queries, and then you in Ghana will be responding to that Aussie guy to give him your advice. And that's the idea. So all across the world there'll be people posting up postings and helping each other out, and there'll be interaction on the notice boards. Now, I'll be taking a look at those notice boards as often as I possibly can and kind of prompting you the right way, but that's the reason it's called an interactive course, because you have the possibility to interact with each other by using the notice boards. But that comes to the subject of emails. Now, you may find that there are administrative problems that happen. It happens in any product, and especially a newish one like this one. Any administrative problems that you have whatsoever, you need to refer those to the administration team. Now, my job, as you can imagine, is to present to the camera, which I'm doing now, and I'll help you as much as I possibly can with the technical stuff. But when it comes to the technology, as opposed to the P2, when it comes to your interaction with the website is slowing down, or you can't download something from the website, there's unfortunately nothing that I can do to me personally that I can do to help you with that. But I can point you in the right direction. When you have a look at the interactive website, you will find that there's a button there for the email to the administrative team. Now, I'm down here in the basement in Holborn. It's a lovely, quiet environment, as you can hear. There's no noise whatsoever. It's fantastic. But I'm right in the middle of a busy college, and above me is a team of 5 administrators who are in the process of digitizing and editing the videos. And then above them there's 5 administrators who are involved in the administration of this course. Now, if you have any queries that relate to, you're having trouble downloading a PDF, or the link keeps on breaking with the website, or the server seems to be running slowly, or something of a technical nature like that, then please feel free to correspond with the administration team, and they will try and help you as much as they possibly can. And there's one other thing that many students don't realize until they get to the end. When it comes to technical queries, queries related to the financial reporting, related to the P2, so not related to the technology, but related to the technical financial reporting, a really good source for answers is the answers in the book. Now, I've actually got a copy here. I've printed off an entire copy. Here's my copy of Peddle that I was using earlier. But I've also got an entire copy, as you can see, of the PDF. Now, there's the basic groups chapter. Here's question fake and stock, which I'll be recording next time, and terror. And over the page you've got question top and toy, etc. And we've got all these questions all the way through. And those are the questions that I'm going to be working through over the coming 10 weeks. Now, as you flick your way through, right the way through, you get to chapter 11, there's share-based payments. If you keep going right to the very back, you've in fact got answers to all these questions. Now, some of these answers are really, really detailed, far more detailed than I would be able to do to video. So if there's a particular problem that you have about a question, the first thing I would do is try and solve it yourself without looking at the answers. That's the best of all. Review the video, have a look again at the video, try and sort it out. But if you're struggling with something, well, that's a bit weird, I'm not too sure about that, go and have a look at the back at the answers. There's lots and lots of detail in there at the back as regards the answers to these exercises. And then failing that, of course, as I mentioned, there's the notice board. I think that's really all I want to say to you about the process of being an interactive student. And I really genuinely wish you very, very good luck, and I hope you find it a useful way of learning. Yeah, all I can say is, good luck, and probably this will be the last of the chatty recordings. The rest of the recordings, of which there are many, will be very technical. Now, just as I was just summing up there, there's just one thing that just struck me, and that is this course is 10 weeks, right, but it is very much weighted towards the front. So I suspect I'm probably going to end up doing probably 5 videos to record for the first week. And then for the following week, for the second week, I'll probably end up with 3 videos, I suspect. But as we go through the course, some of those middle blocks will have less recordings. So some towards the end will actually have quite a small amount of video recorded to video. Now that's deliberate, that's completely deliberate. I wanted to front end this course so that hopefully as you work your way closer and closer to the exam, you actually have less and less on your plate, so you can spend more and more of your time revising and going back. So you're looking forward and going back. So in week 9, for example, not only are you doing financial instruments for week 9, but you're also getting a chance to go back and have a look at what you did in weeks 2, 3 and 4. Okay? Well, as I say, my name is Martin Jones. This is P2 Corporate Reporting for Interactive, and I wish you very, very good luck with your course.